Hello, everyone, and welcome. My name is Todd Rich. I am with Nadex, and this is short-term price action, how to trade short-term price action. And you're going to get an introduction to the different products that we've got available at Nadex, namely binary options, knockouts, and call spreads, and how you can leverage those products to try to trade short-term price action in the markets. So there we have that. Before I get into the session, and I'll give you an agenda. We'll go through it. We're actually going to do some demonstrations as well. But before I get in there, our webinars, as are all of our webinars and educational events, are sponsored by our compliance department. I need to share that trading involves risk and may not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk. And please realize this is an educational session. I am doing this for your education. Please do not construe anything I say as a buy or sell recommendation. And that will become much more abundantly clear when I start demonstrating how these products work and show you how to actually use the tools that are available to you to access these markets. All right, I think enough of that. Before I get started, some housekeeping items, or look at that. I actually have a funky slide in there. I have Brian Caprice in there, which is okay because I'm going to tee it up. One, if you've got any questions for Nadex, please email us, customerservice@nadex.com, customerservice@nadex.com. We are here to help you. Now, I want to point out this is an interactive session. I've got my colleague Sophie in the background. If I go over something too quickly, I say something too fast, I'm not clear in one of my points, you've got a question about our products, the Nadex exchange, your account, anything, you can go, you've got a questions box right there on your platform in front of you. You've got access to Sophie right now. So please use your questions box to engage with Sophie. You see, I have my somebody that I partner with every morning, Brian Caprice, and this is a good time for me to plug this because I have his email up there. But every morning at 8 a.m. Central, 9 a.m. Eastern, Brian and I do a quick 15-minute Nadex morning analysis where we look at the news that transpired overnight here in the US, and we look at hot spots in the markets, and we'll do some technical analysis. We'll kind of review what's going on and where you might want to look for hot spots in the markets. That is every morning, and you would catch that live on YouTube. We live stream that on YouTube right at 9 a.m. Eastern, and please join us. The recordings from those immediately go up to our YouTube channel, which kind of tees up. Follow us on social media, and I would highly recommend you go to our YouTube channel. Go to YouTube. You can look up Nadex, subscribe to our channel, and then you can actually look for upcoming live streams, and you can even set reminders for yourself. Hey, they're about to go live, and you can catch them real time, where we dive into the markets and just look for hot spots and potential trade setups. So again, while we're talking about short-term trading opportunities, we try to tee you up with some potential ideas that you might want to look at every morning. Okay, and remember, please send Sophie a message. She's in the background. Please interact with her. Keep her on her toes. All right, enough of that. Let's get into what we came here to discuss. What are we going to do today? The agenda for today is, first, I would like to tee up a little bit on who is Nadex. We've got so many new people in our markets, thousands of people coming into Nadex markets. I think a lot of it has to do with a lot of the activity that's happening in the marketplace. We're all paying attention to the news, and it's drawing people into wanting to access short-term trading opportunities. And a lot of those folks are finding themselves at Nadex. So I want to talk about who is Nadex and what is it that we have to offer, particularly in that short-term trading opportunity space. I am going to then define some of our products. We've got some unique products, different than you'll find in any other exchange in the United States. We've got binary options, we have knockouts, and we have call spreads. And they're, while some of those might be terms that you're familiar with, particularly say call spreads, I want to go through and show you what our products do, why they're designed specifically for retail traders, and then how you can understand how these things move and potentially participate in these markets. I will give you examples of each, and in the end, I am going to do a practical demonstration. I will get on the Nadex platform. I'm going to show you. I find that a lot of people are visual learners. I can talk about this till I'm blue in the face, but it really resonates. Once I've set that foundation and we've talked about it, when you see it in action, you go, aha, I get it. They're really not that complicated. It's just that you might be getting introduced to new topics. Okay, so with that, again, please keep Sophie busy in the background if I say something or if you got any questions, and let's get into it. So first of all, who is Nadex? All right, and Nadex is actually short for North American Derivatives Exchange. We are a properly regulated electronic marketplace. We are regulated by the Commodity Future Trading Commission, the CFTC. It is the same regulator that regulates some very large marketplaces like the Chicago Mercantile Exchange, the CME, or even the Intercontinental Exchange, ICE, who owns the New York Stock Exchange. So we are regulated. Now, the reason I mention that, and when I talk about binary options, I know that you can go online, you can get on the internet, and you might find other binary option providers. Now, in the United States, there are only two properly regulated binary options exchanges. The other one is a much smaller one, and it only has weather contracts, but it does exist. So I can't say we're the only one, but we are for certain the premier one. And that differentiates us from all of the other binary option marketplaces you might find on the internet. Because we're regulated, we have to adhere to the regulations in the United States. You can access Nadex from other countries around the globe. We have on our Nadex website a list where you can access us, but we are accessible outside the United States. We are regulated in the United States. And if you were to use a different provider for binary options, with that, I would say caveat emptor, buyer beware. If anything were to go wrong, you would want any type of recourse. Good luck. They're not regulated in the United States. You'd have no recourse. We are a proper regulated exchange. And what is it that Nadex was built for? We built an exchange with contracts that are designed specifically for the retail trader, right? And what does that mean? They have a low cost to entry and they have defined risk. All of our contracts are small notional value contracts relative to other products. They have a very low cost to entry. You don't need thousands of dollars to trade or look for short-term price action in Nadex markets. We've brought the contract that size down small specifically for the retail trader, and you could just trade multiple contracts if you want to scale up. But everything we've got has defined risk, defined reward. You know what you're potentially getting into before you even do a trade, what you could potentially make and what you could potentially lose, which really are what I'll call safety guards for retail traders so you don't accidentally blow yourself up. You can define your risk, define your reward. Okay. Now, what is it that we offer? I mean, how do we offer those kind of contracts? We offer them in binary options, knockouts, and call spreads. And I'm going to go through each one of those and explain to you what they are. And generally, what a lot of people are doing at Nadex in the retail trader space is they're using short-term technical analysis and their opinion of what's going to happen to try to take advantage of short-term price action. right? And we've got these products and we've got them in different marketplaces. Whether you're looking to trade foreign exchange, we've got them in FX markets. Whether you're trying to take advantage of equity indices. So we've got global equity indexes. We've got all the major US equity indexes. So if you're looking for movement in the Nasdaq or the Dow or the S&P, we've got products that track those. But we've also got products that track, say, the FTSE over in the UK or the DAX in Germany. So we offer equity indexes and then commodities. The hottest commodities, really, the one where retail traders are looking for action, namely energy products like oil or natural gas and precious metals, gold and silver, also really hot in the markets right now. So at Nadex, you can access commodities markets, equity index markets, foreign exchange markets. We do have event contracts, which I'll touch on a little bit, but we offer these with binary options, call spreads, and knockouts. That's what Nadex has to offer. And it's designed for the retail trader so that they can come in and, I mean, our contracts range from a total of $100 up to, I think our largest one's a total of $600. So you don't need thousands of dollars to get into Nadex markets. You can actually come in. In fact, if you trade our binary options, you can come in with a couple $100 and start trying to access some short-term price action. So let's go to what are binary options. I'm going to define them for you, but the truth is you're already familiar with the concept. You just don't know it. Binary options are short-term defined risk-reward contracts, and the contract is made up of three components. Now, what are those three components? Number one, it's an underlying market. Okay, so I mentioned we've got equity indexes, commodities, and foreign exchange. So you've got you pick your market. Then there's a condition, okay? And that's also referred to as the strike price or the level. And that condition is always in the form of a question. Will gold be above 1860? So what you got there is you got an underlying market. Will gold, okay, there's your underlying market, be above 1860? That's your condition. And then there's an expiration time. And we offer a variety of expirations. So will gold be above 1860? And now we're going to give you some choices. And we've got binary options. Our binary options can be as short as 5 minutes. What's going to happen in the next 5 minutes? And we offer those in foreign exchange products. What's going to happen in the next 20 minutes? We offer those short-term 20-minute price action contracts in equity indices. Then we also have 2-hour contracts, daily contracts, weekly contracts. We offer that across all of them. So you can not only choose what market, we offer a variety of markets, we offer a variety of strike prices. Will gold be above 1860? Will it be above 1870? Will it be above 1820? Will it be above 1900? So unlike other binary options exchanges where there's one choice, we give you a variety of choices to choose from. You can pick the price level, the condition, the strike price that suits your trading style. What is it that you're looking to do? And then we've got a variety of expiration times. What's your time frame? Is your time horizon in the next couple hours, 20 minutes? Is it today? Is it this week? So this is something that differentiates Nadex from other binary option providers. Now, interesting thing about binary options, whether you're buying or whether you're selling, and that's something else that's different. A lot of places you can only buy them. At Nadex, you can buy or sell, and I'll explain why you would want to do either. But whether you're buying or selling, your risk and reward or potential risk and potential reward are always known up front. Okay, completely calculatable and very easy for you to know what you're potentially getting into before you enter a trade. All right, now a binary option is going to trade between two prices. It's going to trade between 0 and 100. So the price that you're trading will be someplace between 0 and 100. And let's call 0 the floor, because that will come into play when we talk about other contracts. And then there's the ceiling, 100. It can't go any lower than 0. It can't go any higher than 100. It's going to trade somewhere in that range. Now, as I already sort of teed up, all of our binary options are a type of prediction. All right, it's a true or false prediction. Is this event going to happen? And either the event happens, yes, it's true, or the event doesn't happen and it's false. Now, this is where you get your 0 and 100. Every single binary option in the end will either go to 0 or 100. Because in the end, at that expiration time, whenever the contract settles, it's going to settle at a price, and then you will know, did it finish above, and all the strike prices below, so the price did settle above, all of them will go to 100. They'll settle at 100. The event was true. Any one of the strike prices or condition levels that are above the price, so was it above? No, it didn't get above them. They will all be false, and they will all go to 0. That is why it's a binary option. It's an all or nothing proposition. Either yes, it's true, it goes to 100, or no, it's false, it goes to 0. And just think about that. You're probably familiar with other binary propositions. I mean, let's just use an example: heads or tails. It's only going to come up with one or two. Will the Steelers win this weekend? Yes or no? So I don't want to equate this to sports gambling or flipping a coin. These are the markets. The markets are moving around. So I want to be very clear about that. But the outcome of the product is similar in as much as it either is, yes, it's true, it goes to 100, or no, it's false, it goes to 0. Now, the price that you're trading, you're going to see it trade in a price between 0 and 100, and that price can be thought of as roughly the probability at that moment in time of the event being true. So let's use gold as an example. If gold were trading right at 1860 and there was a binary option that said, will gold finish above 1860, at that moment in time, the condition, the strike price, the level, and the current price of gold are the same. And so it would be reasonable to theorize that that binary option at that moment in time is going to be trading around 50, because there's a 50% chance that it will settle above, and there's a 50% chance it would settle below. All right, so it would be a 50-50 proposition. Now, if gold were trading at 1830 and the question were, is gold going to finish above 1860? Well, gold has to get all the way up to 1860 and finish above it. So the probability of that happening is going to be less than 50. So it's probably going to be trading at a price below 50, say 30 or 20. And so that's the probability at that moment in time. And those probabilities, all right, the probability of it happening will fluctuate throughout the duration of the contract as the price of the underlying moves up and down. It will, interestingly enough, also fluctuate as time, the further away in time. If I'm trading a weekly contract, there's a lot more time for this thing to move around. And for gold, for example, for gold to move around during the week, so it's going to, the probabilities will change. Now, as I get closer and closer and closer to the settlement time, the expiration time, the probability of an event happening, if it's further away from the current price, is going to be closer to 0 or 100. But those numbers can move quickly. And I will show you how dramatically, as you approach expiration, how dramatically the probabilities can change, because eventually all of them go to either 0 or 100. Now, with the binary option, if you think it's going to be above, you buy it and you say yes because you think it's going to go to 100. The cool thing is, if you think an event's not going to occur, no way is gold going to get above that, I can sell it and say, no, I don't think so. And you can profit if gold does not settle above that price. Now, again, if it does, it goes to 100. Every trade you make is defined risk, defined reward. And I'm going to show you that on the order ticket when we get over there. But that is what a lot of people are coming to Nadex for, are the binary options, which is why I start off there and why it'll be the first one that I demonstrate. And when we walk through an example, you're going to go, I get these. These are kind of cool. They're exciting, and it offers you a different way to play the markets for short-term trading in a defined risk, defined reward way. All right, next I want to talk about briefly, I want to talk about knockouts. Now, what is a knockout? Now, a knockout is probably the most intuitive product that we have. Okay, a knockout is a contract. Now, it too is going to trade within a set price range. We're going to define that price range up front, and that price range, again, I'm going to call it a floor and a ceiling. We are going to pick a product and it's going to trade, and there's going to be a floor on a knockout and there's going to be a ceiling on the knockout. And the product will trade between the floor and the ceiling. Now, the cool thing about knockouts is they are what we call a delta 1 product, meaning the price of a knockout will track pretty much exactly the price of the underlying. So what are you actually trading is you're trading the price of the underlying. Again, I'm going to go back to gold. If you thought gold were going higher and we were trading at 1860, you would simply buy it, okay? And if you thought gold were going lower, even though you don't own it, you could speculate that the price of gold were going lower and you could sell a knockout. Okay? So same as any market, if you think it's going up, you buy it. If you think it's going down, you sell it. And the price that you're trading is the price of the underlying. It's very intuitive. That's something people are familiar with when they trade stock. Hey, if I think Apple computer is going higher, I buy stock in Apple. If I think Apple are going lower, excuse me, you can short sell it. Now, there are all sorts of regulations around all of that. Here at Nadex, very easy. You've got a product, you think it's going higher, you buy it. You think it's going lower, you sell it. But remember, it's a knockout. It's got a range around it. It's got a floor and a ceiling. So let's talk about those floor and a ceiling. Knockouts expire in one of two ways, either price or time. Now let's talk about price first. If the underlying market, the Nadex indicative index, touches the floor or the ceiling of that contract, the contract is immediately settled. It's called a price triggered settlement. And the reason these are called knockouts is if you buy or sell a knockout and it touches either the floor or the ceiling, you are knocked out of the trade. That is why it's called a knockout. If I buy a knockout and it goes to the ceiling, I would get knocked out of the trade for maximum potential profit. Thank you very much. I knew how much I could potentially make on that trade. I was buying a price. There was a ceiling. That's the most I could make. So it moved from my buy price up to the ceiling. I get knocked out for maximum potential profit. And I will show you on the order ticket, it tells you exactly how much you could potentially make if it touches the ceiling. Now, conversely, if I buy a knockout and it goes down, I was wrong. It will knock me out. It touches the floor, I would get knocked out for maximum potential loss. So really what you got to think of a knockout in other markets, it's an OCO, one cancels the other. It's a bracket order. It essentially says if I buy it because I think it's going up, I've got a profit goal where it's going to force me to take a profit. Boom, and there's no slippage. It's not a stop at that level. It hits that level. I know exactly how much I can make. The contract settles. I'm out. Thank you very much. Conversely, it's also got a stop loss, right? If I buy it and it goes down, I will get knocked out of the trade. Now, there's no slippage at the bottom either. I'm not going to trigger an order that says sell it and I get filled way below. No, it touches that. the contract settles, I am knocked out for maximum potential loss. Now that's exactly opposite if I sell a knockout. Hey, I think gold's going lower. I want to try to take advantage of a short-term move in gold. I think it's going to go lower in the next 2 hours. I sell it. If it touches the floor, I get knocked out, maximum potential profit. I sold it. It went down, touched the floor. Thank you very much. But I also have that boundary to protect myself if I'm wrong. I sell a knockout and it goes higher. Oops, I was wrong. And it touches the ceiling. I am knocked out for maximum potential loss, but I'm not going to lose anymore. So it really is, it's sort of like a predefined trading plan. When you trade a knockout, it is delta one. Do I think this equity index is going higher or lower? Do I think gold or oil are going higher or lower? Do I think this FX pair is going higher or lower? I can take a position and I've got clearly defined exit strategy. If I'm wrong, it'll knock me out for a loss. If I'm right, it will knock me out for a profit. Now, the other way a knockout can settle is, let's say you trade a knockout and it trades between that floor and ceiling, but never touches either one of them. Eventually it will settle. Our knockouts are all 1-week contracts. So at the end of the week, it will settle at a price. All right, boom, okay, here's the settlement price. And your profit or loss will be the difference between where you bought or sold it and the price that settles. If I bought it and it settles higher, I'll have a partial profit. If I bought it and it settles lower, I'll have a partial loss. Converse, if I sold it. If I sell it and it goes higher, partial loss. I sell it and it goes lower, partial profit. But getting into it, what your maximum potential profit or potential loss are, because you've got those boundaries, the floor and the ceiling defined up front before you even do the trade. Those are knockouts, and I think those are probably our most intuitive product. You're trading the price of the underlying. Now, some people don't like that knockout component because they might be right. They might pick a direction. Let's say I think gold's going higher and it goes lower for a little bit. It touches that floor. I get knocked out and then immediately it goes higher. And I go, God, why did I was too close to the floor and it knocked me out and I was right. Well, welcome to call spreads. All right, a Nadex call spread also trades in a predefined range, and that range also has a floor and a ceiling. Now, the value of a call spread is going to move in line with the underlying, similar to a knockout. Okay, so call spreads aren't too dissimilar from knockouts, but there is a huge variance between call spreads and knockouts, and that is call spreads are different from knockouts in 2 distinct ways. Number one, a call spread only expires at expiration. So there is no price triggered settlement. Meaning, if I buy a call spread and it goes down and it hits the floor, I am not knocked out of the trade. I am still in the trade, which gives me more time to be right. Now, when I bought that call spread, I knew I had defined risk and defined reward. So if I buy that call spread and it goes down and it keeps going down and it keeps going down, I actually have defined risk. What I paid for that, I cannot lose any more than what I paid for it. So in that regard, again, you've got very defined potential profits, very defined potential losses, but if it crosses through the boundary, you are not knocked out. Now that's really cool if you're wrong. Ooh, I bought gold, it went down, it went through the lower level, and then it went all the way back up, I could still potentially profit. All right, now if it goes through that upper boundary, I'm not knocked out either. I'm still in this trade. So if I want to get out of that call spread position, I either have to wait till expiration and see where it settles, or I can just simply sell it and get out of it. But you're going to have to manage that much more manually. A knockout is automatic. Now, because of that optionality, because a call spread, you don't get knocked out, there's going to be components to the price that you see in a call spread that makes it distinctly different from a knockout. It is not a Delta One product. Because there is optionality built into it, there is going to be a premium factor in the price of a call spread. And if there's a lot of volatility, that premium level will be higher. If there's little volatility, that premium level will be lower. And if there's a lot of time left in the call spread, that premium will be higher. And if there's little time in call spread, that premium will be lower. So volatility and time to expiration will be factored in to the price of your call spread. So when you look at the prices that you're trading, they are not going to match exactly to the underlying product. They are not Delta One, right? So if you buy it, you're going to have to pay a premium. If you sell it, you'll see the price that you're selling is going to be below the current market. When you buy it, it's going to be above the current market. You're going to see that premium component in a call spread that gives you that optionality. And so that gives you that time to be right, as opposed to a knockout, which is a Delta One, no premiums involved, but clear, distinct knockout levels. Hopefully that helps you understand the difference between knockouts and call spreads. Now, something that I've intimated, but if you take nothing else away from today's session, I want you to take this away. I can't emphasize this enough. I'm going to call it an important rule when trading any Nadex products. Just because there's an expiration time and date associated with the contract does not mean you have to wait until then to see what happens. Right? You do not have to wait until expiration to see what happens. This is the number one thing. I can't say this loud enough. I can't emphasize this enough. This is one of the biggest challenges people new to Nadex have is you can choose to exit a position early. You can choose to unwind your position just like you can in any other market. And I will tell you, other binary options exchanges don't offer that opportunity. But with Nadex, you can choose. And why would you want to exit a position early? You would want to exit it for two reasons. One, you want to lock in profits. Or two, you want to limit losses. And you might want to do that prior to expiration. So, example, I'm trading a binary option. And the condition is much higher than where the current price is. So the strike price is above my condition level. And again, I'll use an example. Will gold be above 1860? And let's say gold's trading at 1830, and let's say I can buy it's a 20 probability that it gets above 1860, and I could pay 20 for that. Let's say gold does in fact go up and it goes right to 1860. Now that contract's trading around 50. What do I want to do? Do I want to wait and see if it goes to 100? Or do I want to risk it going to 0? I might say, well, I bought it at 20. I might want to just sell it at 50. Thank you very much. Now, the interesting thing about our binary options is they're all $100 contracts. So even when you're looking at those numbers, it's actually the dollars. If I buy one binary option for 20, yes, there's a 20% probability that it will finish at 100, meaning I risk 20 to potentially get 80 because it would go to 100. It's $20 to potentially make $80. All right. Now, if I buy it at 20 and sell it at 50, well, I paid $20. I sold it at 50. That's $50. I risked 20 and made 30. That's 150% return on your money. You might want to just say thank you very much. I was right, and I don't want to wait to see what happens till expiration. I don't want to risk it going to 0. Now, let's say it goes a little higher and you could sell it at 60. For sure, you can do that as well. So you can exit a position early. You do not have to wait. Same goes for a knockout. I buy a knockout and it starts going higher. It doesn't get to the ceiling. I don't get knocked out of the trade, but I'm willing to sell it at a higher price. I'm out, so I bought it. I liquidated my position by selling it. I take the profit between the price difference between where I bought it and where I sold it. Or I sell one and it's because I think it's going lower. And it goes lower, I can always buy it back at a lower price. Now, it goes true to protecting risk as well. If I buy a knockout and it starts going down and it's going down and I go, oh, I really thought it was going to go up. It hasn't touched the floor yet, so I haven't been knocked out for maximum potential loss. I can limit my losses by simply just selling out my position and saying, oops, I was wrong. I don't want to wait for it to go all the way down and hit the floor. I'm willing to just get out now. Now, because we offer different knockout levels, you can choose where that floor and ceiling are, so you can help manage your risk. That's one of the reasons why we offer 4 knockouts for everything, and I'm going to show that to you so that you can choose the right floor and ceiling that fit your trading style. And the same goes for call spreads. And I said that during the call spreads, is because you're never knocked out of the trade, it will only settle at expiration. If you buy a call spread and it goes higher, the folks that are successful at Nadex that we've seen or that I've seen often will, if I bought it and it went higher, I'll sell it and take my profit and I'll move on to another trade. Or conversely, I'll sell it, it went down lower, I'll buy it back. Thank you, and I'm done. Same goes for managing risk. I can't emphasize that enough. Obviously, everyone's looking to take a profit, but managing your losses is an important component to any trading plan. If I buy a call spread and it starts going lower and I decided I'm wrong, I chose poorly, you can just sell it, take a loss. You don't have to take maximum potential loss. You can choose. So this slide, you take nothing else away. Just because there's an expiration associated with these contracts does not mean you need to wait until then to see what happens. Okay, I'm just going to put this up here for a second. Remember, I see that you guys have been actively engaging with Sophie in the background. I hope she's been getting to all your questions. And I'm just going to take a quick, can I talk about, I'm betting a stop loss. Okay, I see that question, stop losses. Now, I can tell you that we are looking at adding stop loss functionality into our platform. It's something we are trying to build. But what's interesting about all of Nadex products is because everything has a defined risk, defined reward, because there's that defined risk, there's essentially a defined stop loss. You know exactly where you're getting into. And what we do is we offer different binary options. So you can choose the binary option where you're risking the least amount of money, but still trying to profit from what you think is going to happen. Same for knockouts and call spreads. You just have to choose the range that suits your trading behavior, where you minimize the amount that you could potentially lose, maximize the amount you could potentially make. And so you can manage your potential profits versus your potential losses, would be your stop loss, by choosing the right contract in each one of these markets. So hopefully that helps. And when it comes, that's one for protecting losses. When it comes to locking in profits, you can place orders away from the market. You don't have to be in front of them. And that's the cool thing about Nadex too. In fact, let's do this. I want to get over to the Nadex platform and spend some time there, because you can place orders. We have a central limit order book. You can try to buy or sell between the bid-ask spread. Someone may not trade with you, but you can choose to do that. But you can post liquidity. And if you're trying to sell something higher, you can put an offer in higher. And if it trades up there, great. Or you could put a bid down below, and if it comes down and someone hits your bid, you could buy it lower. So you can put orders away from the market on Nadex, something also very different than other binary options exchanges. So, I mean, we offer that flexibility because we have to. We're a regulated exchange in the United States, and some of that is expected when you have an exchange in the United States. So let me, I'm having some issues here. Let's try this again. I want to just switch what I am sharing. There we go. All right, you should now be looking at the Nadex platform, which I see that you are. Okay. Now, a couple of things. Before I log on to the platform, I do want to point out, if you go to the learning section of our website and you go down to webinars, okay, you will see all of our upcoming webinars. so that you can register for any of these if you like. Okay, so you just take a peek at what's up here. But if you also want to go back and get some education, take a look at our archive, and we store all of this here. Now, and I've talked about knockouts and call spreads briefly today. If you want to do a deeper dive, I did a deeper dive just earlier this week. We also just had an entire day of education. We called it New Year, New You, Better Trader. It was a free day-long education summit, and there were 6 different sessions. And if you want to learn the basics of technical analysis, like you don't even understand what technical analysis is, what is this thing called a chart? A chart is made up of candlesticks. What are candlesticks? How do I read these? We've got some very basics for you to help you along your journey. But it was a great day of education. Different folks, trader psychology, building a trading plan, ideas around trading volatility. If you want a deeper dive into binary options, just full-blown binary options, you can see I just did that a couple weeks ago. But we've got a lot of education in here. You just got to scroll through. I'm constantly curating it to take away some of the older stuff, but we've got some evergreen content in there that might really help you. You know, I am going to click on one other thing, and let's just see what happens. And I'm curious. Good. I want to make sure that you're still seeing this. This is part of our YouTube channel. All right. And I'm hoping that if I do this right, I can get over to our YouTube channel. And I would recommend that you go to Nadex YouTube. All right. And if you click on videos, okay, one, I would recommend that you follow our channel, that you subscribe to it. The second thing is, if you click on videos, all of our videos and all of our new ones, they're also located here. I'm recording this session, it will show up here. It'll also be on our website. The reason I'm pointing this out is you can see my colleague Travis McGee early in the morning. He's our chief commercial officer. He does a quick 1-minute update, 30 seconds, a minute. What's going on in the world? And then a couple hours later, I do a full 15-minute analysis, and we do stream these. And if you take a look, upcoming live streams, now we've got the one for tomorrow up there. You're more than welcome to join us. You can set a reminder and join us. I'm about to put up next week's. I can only put them out 1 week at a time, but you'll see in here all of next week's, probably later today. And you can remember, join us 9 a.m. Eastern, 8 a.m. Central, and we do a little bit of an analysis, technical analysis, hot spots, what's going on, where you might want to look every day. So I recommend that. I wanted to show that quickly. Now, let's jump back to the Nadex website. Let me take a quick peek. I just want to see, because I see you guys. Okay. Okay, I'm going to explain. I see a question about protecting profits. I am going to show you an example, okay? So let's go ahead, and I'm going to, you know what, I might have to log in and, oh, good. Let's go to a demo environment. Now, I want to tee this up. If you do not have a demo account at Nadex, get one. They're easy to set up, and you can paper trade. You can practice. Now, your experience in demo is not going to be identical to what you see in live. The prices are going to be very, very close, if not the same. But because you've got different people doing different things, a live environment, you got a lot of people looking at a live environment and wanting to trade. In demo, it's whoever happens to be looking at demo at the moment. So there's a distinct difference in your interaction with the marketplace. But this, the experience, what you're clicking on and what you see is nearly identical. Now, let's first, I'm going to do a knockout first. Let me see something quickly. No, let's do binary options first. I'm going to go to binary options, and I went into 5-minute binaries. There's 4.5 minutes left in this binary option. And let's just take a look at the pound US dollar, and notice how we've got a bunch of different choices. I'm simply going to click on one of them to populate the chart. I'm going to make this a 1-minute chart because we're looking at a 5-minute binary option, and I am going to zoom in so you can so you can see what's going on. And let's talk about a few things here. One, notice how we've got your strike prices over here. Notice how this is currently above this one, and so it's trading at a 60, and this it's below this one. Let's say I think the pound US dollar is going to go lower, so I want to sell one. Now, you know what? I put an order in and I tried to say, oh, I sold it. I sold it at 46 and a half. Look at, there's my position. I sold one at 46 and a half. It's going higher. It's going in my face. Now, if I wanted to buy it back, I could simply try to buy it back and take a partial loss. Now, I sold it. I think it's going lower. Now, how would I protect my profits? I could protect my profits by placing a bid. I bought it at 46 and a half. Maybe I'd buy it back at 26 and a half. I can put a bid below. All right. Now, I'm placing an order to buy it 26. It's way below the market. I'm going to place my order. You're now going to see my order down below. Now, there's only 3 minutes left here. I may not get it back. Now, when I sold that at 46 and a half, let's just look, and it's going in my face. I sold at 46 and a half. I knew at the time that the most I could make is if it went, oh, you know what? I want to put sell 46 and a half. There we go. The most I could make was 46 and a half if it went to zero. The most I could lose, it goes to 100, I would lose 53 and a half. So when I sold that, I knew exactly what I could potentially make and what I could potentially lose. Okay. Now, watch, we've only got 2 minutes left here. And as time moves on, these prices, notice this one down here at the 37 and a quarter, it's up, already trading 95%. There's only 2 minutes to go. The market's saying it's probably not going to come down below here. The one that I sold at 46 and a half is in the 70s. It looks like I'm probably going to lose on this trade, but I might not. You'll see if the price starts moving lower, this probability will drop very quickly. If it goes higher, this probability, which is currently in the 30s, is going to go, if it goes up, this will go up very quickly. Right now, there's not a lot of volatility. It's going down. Look at that. We're watching it go down, and we watched the probability of this one start dropping dramatically. Now, the one that I sold at 46 and a half, well, it's coming back closer to 50-50, but there's only a minute and 20 seconds to go. What is going to happen? Now, I've got a bid below at 26 and a half. If this thing starts dropping down through here, I actually might buy it back at 26 and a half. Oh, it's ticking back higher. Look how quickly these volatilities move away from that 60 level, because again, what's happening, there's less than a minute to go. Now, I could simply say I was wrong and just want to close this position. I'm going to go ahead and delete this order, and let's go ahead and look. Do I want to buy it back? Oh, it's coming back. I mean, look at this. I really don't know what's going to happen. It's coming back coming down. There's only 36 seconds. You know what? I'm going to buy it back. I was wrong. Oh, I didn't. I put a price in at 62 and a half. Oh, there. Now, something interesting just happened. When there's about 20, 25 seconds to go, let's cancel this. Notice how the prices all went to zero. That's because no one knows what's going to happen here. If it stays above here, and there it goes, it's going to stay above. 2, 1, that contract just settled at 100, and I lost. I should have bought it back. I didn't. I could have managed my losses. I didn't. I took a little bit of a risk, but it stayed above here, and it went to 100. Now, after 5 minutes, these things, all the prices reset. So if you want to refresh, you can simply refresh this, but you can see that I've got brand new probabilities and a brand new set of strikes. Every 5 minutes in these foreign exchange pairs, you can trade these binary options. And as this thing, look at it, as this comes down back to the same level where I was, it's as long as it's just above, it's going to trade just above 50. It drops down below, and you see how dramatic these probabilities can change as the price of the underlying moves and as I approach settlement. I mean, this has got another 4 minutes to go. All right, so I hopefully that answered. All right, now I'm gonna move to knockouts. Okay, I just wanted to show binary options and I thought a 5-minute binary option would really amplify the movement in these probabilities. You do not have to trade 5-minute binaries. You can choose, for instance, if I go to indices and we want to look at, say, the Nasdaq, the U.S. Tech 100. Notice how we have hourly expirations. Here's one that's, I mean, these are going to settle in 8 minutes. All right, they started off a couple hours ago. Here's one that settles at 2 p.m. Eastern. All right, so you got an hour to go. I mean, we give you a variety of choices, or you can look. I mean, if that's too short of a time frame for you, there's daily and there's weekly. Now the weeklies aren't going to move as dramatically, but you can still choose a level. Do I think it's going to be above or below certain strike prices? Oops, maybe I didn't click one. Oh, something I'm in demo and I'm trying to figure out what I've. There we go. I had to shrink the chart down. The strike prices, notice when we go out weekly, they're much further apart. Okay, and that's because we set them at the beginning of the week, and here we are on a Thursday. When we set daily, hourly, and by the minutes, the strike prices, you'll have more choices to choose from. So when you're trading binary options, it's not just about picking which product, indices, foreign exchange, commodities, but also the duration. What is it that I'm looking for? What's my time frame? Those are all choices you have. Now let's go over to knockouts. And I want to do an example in knockouts. Since I was talking about gold earlier, I'm just going to go ahead and pick gold. And I'm going to click on one of the knockouts. I'm going to move this out of the way. And what's cool about knockouts is you'll see on the chart, there are 4 blue vertical lines on the left-hand side. This is me rotating between the different knockout levels. Now, this is how you can manage your risk. If I thought gold were going higher, okay? I think gold's going higher. This settles tomorrow. These were weekly contracts, so there's 1 day left in the week. But if I think gold were going higher, I might choose this knockout. Now, this tells me the floor is 1838. The ceiling is up there at 1888. Now, if I were to, let's click this and click this. There we go. Now, if I were to want to buy this contract, we are very close to the floor, 1838. Now, if I bought one here at 1841, if it dropped down and touched 1838, I'd get knocked out for a $30 loss. Now, if it were to rally and go all the way up, I could potentially make $470. Maybe this is too close for comfort. Maybe I want to give myself a little bit of breathing room to the downside. I might choose a knockout level with a little bit more room to the downside. But now notice, if it goes down, my floor is 1828. There, I could potentially lose 138, but at least I got a stop loss in. I can't lose any more than $138, but I think, and by the way, this is a 1-minute chart. Let's take a look at a 15-minute chart of gold. Oh, I mean, look at gold rallied today and has sold off all day long. Part of this was around the GDP numbers coming out. And now that it's rallied all the way down here, I might want to buy one, okay? And again, this is not a buy or sell recommendation. I'm simply saying, let's say I wanted to go long a knockout here. I'm going to click buy. I do not have to buy the offer. I could put a bid in at 1840.30. 1840.30. All right, I'm going to place my order. Oh, my order went in and it immediately went and filled it. You would have seen that between the bid-ask spread. Now, all right, I've got a position. I bought one at 1840.30. Now, if it continues to go down, I could potentially lose 123. That is my stop loss. All right, I could lose $123 if it comes all the way down here and touches the floor. Now, how could I protect my profits? Do I have to wait for it to go all the way up? And the ceiling on this contract is 1878. I think it might only go back up to 1860. Let's just say 1860. I'm going to pick a nice even number. Could I sell one up at 1860? 1860. All right. Now, yes, I could place an order above the market. I'm long one. All right. I own it. If it gets up to 1860, I want to sell it for a partial profit. I don't think it's going to get all the way up to 1878. I can place an order to sell it above the market. What did I just do? Oh, did I not place the order? 1860. Oh, hello. I was on buy. I want to sell one at 1860. Look at that, rookie year. All right, I want to sell one at 1860. I want to sell it above the market. Okay, I accidentally bought a second one. I could place my order up at 1860 above. I go over here to my orders and I'm trying to sell one at 1860 above. So I bought it down here. I want to sell it up here. I can try to lock in some profits if it goes up here, but I'm protected to the downside. So I can control my risk parameters. Now, can I set a stop loss to sell it down here? Not yet, but I do have that level. And if I didn't want to risk 100, where did I bought it? I bought it at 141.30. I didn't, I wanted to risk less than 133. I could have chosen this knockout where my downside was only $30. So you've got to choose the range of potential profits, potential losses. Now, let's say I think gold, we're going to go lower, okay? It rallied this morning. What a joke. It's going down, and I think it's going to continue to go down. I might, choose to sell a different one, all right? If I thought gold were going lower, I could potentially sell this knockout. Now, if I sold this knockout, and let's just use 1841. Let's use a nice round number. If I sold one at 1841 and it went up and hit the ceiling, I would lose $170. If I sold one and it went down and touched the floor, I'd make 330. And if it trades in between, and again, this goes back to, do I have to wait until expiration to see what happens? No. If I sell this and it goes up, I can always buy it back for a loss. If I sell it and it goes down, I could place a bid down below to buy it back sooner rather than waiting for it to go all the way down to the floor. So now, I think I covered it. The question though comes back, if I on my long position, let's go back to my long position. All right, I bought two of these now at a average price of 184.35. The question is, I bought these two. Could I set a stop loss to sell below? Not yet. It is coming. We are working on that. But the inherent nature of the products themselves, I do have a stop loss where if it hits the floor. And if I wanted a different risk reward relationship, I could choose a different binary option. Now, call spreads, because I do want to cover them, and might as well just use the ones in gold. I'm going to look at the daily call spreads. Actually, here, these ones settle in 30 minutes. That's fine. I'll just use these 30-minute ones. It looks a little different. Notice when I click on it, it gives me a range. All right, it shows me the floor and the ceiling of this call spread, the center one. All right, and what's interesting here is because there's only 30 minutes left, again, short-term trading opportunities, because there's not a lot of time left, the premium level has really come out of these. This is very close to what the current price is. So if you were looking for short-term trading in gold for the next 30 minutes, a call spread is not too dissimilar from a knockout. I notice you've got some other levels. Now here's where it gets different. I picked this 1840 floor. All right, if I were to buy one of these, all right, now notice that the most I could lose is 28 bucks. I mean, we're right at the floor. If I think gold, we're going to bounce off of here quickly. But notice gold's currently trading around 180.40, almost 180.41, just a little lower. Notice the price I'd have to pay is above 184, 1842. So it's trading around 1840 and a half, and I've got to trade 1842, a whole 1.5 points above. That is the premium level that I'm paying. Because if it were to drop down, I would not be knocked out, and I still have 30 minutes for it to be right, for it to turn higher. Okay. So that is the difference between knockouts and call spreads, and people often choose call spreads with the, I mean, if I thought gold were going lower, okay, from here in the next 30 minutes, I could say, I want to sell this one. I mean, I'm right at the ceiling. I'm right at the ceiling. If I sold it, I couldn't lose any more than $22. Maximum I could lose is 22 bucks. Now, I don't know if it's going to get down to 1800, but if it were to trade lower in the next 30 minutes, I could potentially profit. But notice where I would have to sell this, 1838, is 2 points below 1840 where it currently is. That is that premium level, because that's being offered for that optionality in the call spread. I have covered a lot today. Hopefully I've gotten to your questions. If anyone wants the slide deck today, you can email customerservice@nadex.com. Sophie will get you the slide deck if you want the slide deck. This session was recorded. It will be on our YouTube channel as well as on our website, so you can go back and review at your leisure. Again, any questions you've got, you can email customerservice@nadex.com. We are here to help. I really appreciate everyone joining me today. Hopefully this really helped you understand short-term trading opportunities with binary options, knockouts, and call spreads. We've got plenty of other education up there to offer you. Please follow us on YouTube, and please join 8 a.m. Central, 9 a.m. Eastern every morning, streaming live, and you can get some analysis of what's going on in the markets and where you might want to look for potential hot spots to give you some ideas on what you may want to end up doing. With that, I want to thank you for joining us at Nadex, and I want to thank you for joining me today for this session, and I want to wish everyone good luck in the markets.